Your money is disappearing. Right now. As you listen to this. Not stolen from your wallet. Not lost in the market. It's melting away molecule by molecule, and you can't even see it happening. This is the story of the most successful theft in human history. A crime so perfect, so invisible, that the victims actually thank their robbers. Picture this. You have $100 in your pocket today. In 10 years, that same $100 will buy you what $70 buys today. Where did the other $30 go? Who took it? And why don't you remember losing it? The official story is simple. Prices go up because, well, inflation is natural, it's healthy, a sign of a growing economy. Central bankers call it a necessary evil. Politicians blame supply chains, greedy corporations, global events. But that's not the whole truth. Because here's what they don't tell you. Inflation isn't a mysterious force of nature. It's engineered. And someone is getting rich while you get poorer. To understand how this invisible heist works, we need to go back, way back, to when money was real, physical, and finite. Ancient Rome, 64 AD, Emperor Nero had a problem. The treasury was empty, but the empire needed funding. So he came up with a brilliant solution. Instead of raising taxes and facing rebellion, Nero did something far more clever. He recalled all the silver coins in circulation. Then he melted them down and mixed them with cheaper metals. Same coin, same face value, but now it contained 10% less silver. The people got their same money back, but Nero kept the extra silver for himself. The genius of this system? Nobody noticed at first. The coins looked identical. But slowly, gradually, prices started rising. Merchants needed more coins to buy the same amount of silver. The purchasing power of every Roman citizen quietly evaporated. But this is where the story gets really interesting. Because that was just the beginning. Fast forward to today. We don't melt coins anymore, we don't need to. We have something far more powerful. The printing press. But the principle is exactly the same. Instead of mixing silver with copper, we're mixing real money with nothing. Here's how it works in the modern world. When the Federal Reserve creates new money, they don't drop it from helicopters evenly across America. They don't mail you a check. Instead, they inject it into the financial system at very specific points. Banks get it first, then big corporations, then government contractors, then eventually, maybe it trickles down to you. This creates what economists call the Cantillon Effect. Named after an 18th century economist who figured out the dirty secret, the first people to receive new money benefit at the expense of the last people to receive it. It's like a game of musical chairs, but with your purchasing power. Think about it this way. Imagine the government prints $1 trillion tomorrow. Wall Street gets access to this money immediately. They use it to buy stocks, real estate, commodities. Prices for these assets skyrocket overnight. But your salary? Your savings account? They stay exactly the same. Meanwhile, the price of everything you actually need starts creeping up. Rent, groceries, gas, healthcare. By the time you notice, the wealth transfer is already complete. The asset owners got richer using the new money. You got poorer using the old money. And here's the most insidious part. This whole process is invisible. There's no theft in the traditional sense. No one broke into your house. No one touched your bank account. The numbers stayed the same. But your money's ability to buy things just evaporated. Let me show you exactly how this played out in recent history. March 2020. The world shuts down. The Federal Reserve's response? Print more money in 8 weeks than they had printed in the previous 2 centuries combined. $6 trillion. Created out of thin air. Where did it go first? To banks, to large corporations, to asset managers. They used this fresh money to buy everything in sight. Stocks hit record highs. Real estate prices exploded. Art, collectibles, Even meme stocks soared. If you owned assets, you got massively richer. But if you were living paycheck to paycheck, holding cash, saving money in a traditional savings account, you watched your purchasing power get decimated. Gas prices doubled, grocery bills skyrocketed, rent became unaffordable. The Federal Reserve called this economic stimulus. But stimulus for whom? The data tells the real story. During this period, the wealth gap reached levels not seen since the 1920s. The rich got richer, the poor got poorer, and the middle class got hollowed out. This is the invisible tax in action, and it's happening right now as we speak. But here's what makes this system truly genius. Most people never connect the dots. When your rent goes up, you blame your landlord. When groceries cost more, you blame the store. When gas prices spike, you blame oil companies. The real culprit remains hidden in plain sight. The psychological invisibility is the system's greatest strength. If someone stole $30 from your wallet, you'd call the police. But if inflation steals $30 of purchasing power from your $100 bill over 10 years, you accept it as normal. And that acceptance is exactly what keeps this system running. Because the moment people realize what's really happening, the moment they understand they're being systematically robbed, the whole game falls apart. So who benefits from this invisible tax? It's not random, it's not accidental. There's a clear hierarchy of winners and losers. The biggest winners are those closest to the money spigot. Commercial banks who get access to newly created money at virtually zero interest rates. Investment banks who can borrow this money and use it to speculate in financial markets. Large corporations who can issue bonds and borrow at artificially low rates. The second tier of winners includes anyone who owns hard assets. Real estate investors, stock market participants, commodity traders, art collectors, even cryptocurrency holders. Because as new money floods the system, these assets act like sponges, absorbing the excess liquidity and rising in price. And the losers? Anyone holding cash, anyone with a fixed salary, anyone who saves money in traditional bank accounts, small business owners who can't access cheap credit, retirees living on fixed incomes. Basically everyone who plays by the old rules while the game has secretly changed. The numbers are staggering. Since 1971, when the United States abandoned the gold standard and began printing money without limit, the purchasing power of the dollar has declined by over 85%. That means your great-grandfather's dollar could buy what $15 buy today. But here's the really disturbing part. This isn't happening by accident. It's policy. Central banks around the world explicitly target 2% inflation per year. They call it healthy. They say it encourages spending and investment. What they don't mention is that 2% inflation means your money loses half its value every 35 years. It means that over a typical working lifetime, the purchasing power of your savings gets cut by more than half. Not through bad investments, not through market crashes, through official government policy. And if you think 2% is bad, remember, that's just the official target. The real rate of inflation, especially for things people actually need like housing, healthcare, and education, has been much higher. For many Americans, the real invisible tax rate is closer to 5% or 6% per year. So what can you do about it? The first step is awareness. Understanding that this isn't natural, isn't inevitable, and isn't in your best interest. The second step is protection. Moving your wealth away from assets that get destroyed by inflation and toward assets that benefit from it. But the most important step is recognizing that this system only works because people don't understand it. The moment enough people realize they're being systematically robbed through currency debasement, the moment they demand sound money instead of political money, everything changes. Because here's the truth they don't want you to understand. Money is supposed to be a store of value. It's supposed to hold its purchasing power over time. It's supposed to reward savers, not punish them. The fact that it doesn't do these things anymore isn't a natural evolution. It's a choice. Every time you hear about inflation, remember, someone is getting rich while you get poorer. Every time prices go up while your paycheck stays the same, remember, this is a wealth transfer, not a natural phenomenon. Every time you're told that inflation is necessary for economic growth, remember, it's necessary for their growth, not yours. The invisible tax is the most successful con in human history. But like all cons, it only works as long as the marks don't know they're being played. Now you know. The question is, what are you going to do about it?